Good day, traders. Stacey Burke from Stacey Burke Trading, and we're just going to go over again a couple of key things regarding end of day trading, the opening range, just looking for some basic, really simple trigger bars like pin bars, inside bars, engulfments. And I'm just going to go demonstrate the last month in some of the major pairs. I just want to remind you, go and check your average true range on the majors or any of the pairs that you're trading. So if you're looking at any of these types of triggers for end of day trading, a couple of things you want to hone in on is basically, it doesn't matter what time frame you're on, the candles will obviously all look very similar. And the thing to remind yourself of is that, you know, if it's a weekly chart and you have a weekly ATR, well, that's obviously going to be driven by Monday to Friday price action, but also over the course of the month, the average true range of that instrument's pair, that instrument, your end of day trading can allow you to start to position yourself when these triggers show up with managing the downside in terms of knowing what your maximum loss is going to be on that trade, not being at the screen and potentially participating into some large moves when these triggers show up and there's momentum in the markets. So again, not looking to hit every trade. As I've said before, look for one or two real high probability trades every month on the majors, or get used to following, you know, 2, 3, 4 pairs and just getting the process down. You'll be amazed at when you start to do that, how much movement occurs in the market and how much possibly opportunity you're missing out on by being on the short time frame intraday charts. Now, one of the things as a retail trader, we seem to think that we've got to try and time these trades on a 5-minute or 15-minute chart and load up on these. Now, these are the types of trades that usually end up blowing up accounts at some point. So I'm just encouraging you to step back and look at some of these trades, think logically about what the market's doing, and understand the price action Monday to Friday and how some of these trigger bars can give you an idea about participating in the market with limited downside. Okay, so these black dark spotted lines are the beginning of the month, and obviously we're looking at the Euro, USD, and heading into the beginning of the month obviously was a range. And you know, if we back it up, obviously there was some selling off that occurred going into the beginning of September, but the market seemed to be range bound for most of the month. But as we got into the beginning of October and we start to go bar by bar, the market started to coil underneath of the moving average. And we know, if you know anything about the moving average squeeze, you'll often get a tease break, but then came our gift, which was the inside bar. Now, this is a classic example of putting a limit order in the direction of the momentum. So we see that there's order flow going down. Now, traders may perceive this as the market struggling to go down, but this is a classic moving average squeeze. Now, regardless of what you think, one of the things that you need to try and get through your trading mind is that every trade is going to be a random outcome, and every trade is just another trade. So regardless, as you can see from this trade has a maximum loss of the range of that bar. So whether you see that bar as being the bottom of the range and you don't want to go short, whatever it is, it's still only going to be a maximum loss. We're not saying that this market is going to go down. We're just going to allow, this is a Monday, as evidenced by the dotted line. The market has opened up bearish. We've got evidence of order flow already occurring in the markets. We've got a tease break, which is classic on an EMA squeeze. We're limit order at the low of that inside bar. If you want to be more aggressive, you can be, but I'm just giving you a simple example of how these bars occur and how they show up. So short traders were taken into the market, and that momentum carried through quite strongly. This is an example of where, when you see that kind of momentum, you want to be going to break even right away the next day. The market gave a 1-bar pullback. Now, if you followed Al Brooks' price action and you know that that 1 bar pullback, lower high, lower low, H1, aggressive bears would short that bull bar, and even if you're shorting that bar, you can again establish a maximum loss either at the high of that candle or the low of the inside bar candle, or even at 3/4 of the range. Whatever you want to do. This is an example of where you can again start to add into winning trades and still manage your downside. But again, as we trade through the rest of the month, we see another evidence of a 1 bar counter trend. And again, if you were to short the high of that candle or the close of that candle, we have a bear bar that if that's an institutional bar, that market shouldn't fail. That bar shouldn't fail, sorry. So we again want to define our maximum stop loss on that trade. So if you were to short somewhere in here inside of that bear bar, you still want to define your maximum stop loss. So the market again aggressively sold off. Then we saw the pin bar appear. Now again, another inside bar. We don't have, even if you were to try and trade that short again, you'll notice that down here shorts were not taken into the market. But if you know anything about the auction process, when this reversed on the Monday Tuesday open and it broke out above Tuesday's high, now we've got potential of two-sided trading. So this was a very weak response by the bears. Now aggressive bulls may have put a 1 pip stop above that bear bar in anticipation of that retesting the range from the previous week. But again, coming back to our original premise, we're only looking at just simple trigger bars. So we had our inside bar towards the beginning of the month with an EMA squeeze. We had a tease break already in place, and that was a really high possibility trade with a limited downside. So again, we look at the Aussie dollar. So a fairly range-bound market going into the beginning of the month. We don't see any inside bars, but we do see a pin bar. So again, you have to have the patience to wait for these trade setups. So bar by bar here, we see an engulfment bar show up for bears. So bears may have shorted that. Anything inside of that bear bar would have been shortable, but again, just looking for a pin bar or an inside bar, we don't see any of that until we come across the pin bar. So again, we're looking at something that's moved down, and now we've even been able to establish a range that this can possibly trade back to. Okay, now what's really important about these trigger bars is that what I love about them is that I can define my maximum loss on this trade. Now you might want to do 0.9 ATR of that bar, or 0.9 of that range, or 0.8 or 0.75, or just use the range of that bar and calculate your position size accordingly. So again, simple trigger bars. Now this is probably at least a 2-to-1 return on that trade. So again, we see an engulfment bar. We see the market struggle down and create another inside bar. And again, I'm going to encourage you to be looking at these days of the week, Monday to Friday. And you've heard me say before, I don't trade on Monday, but this is an inside bar. Now again, not to say that was tradable, but if you traded back against that, obviously you're looking at trading against the momentum of the previous week. But look what happened on the Wednesday, a pin bar. So a situation like this, the market breaks to new lows. So we've got very strong momentum on the Thursday. The market breaks to new lows. You want to be moving your stop to break even once that occurs. Highest probability of a market having a marginal new higher low or a false break, whatever you want to call it, and also out of balance. So this is the highest possibility of a candle having volatility the next day and the market returning to range or continuing on strongly. So you want to be at break even when that occurs. Looking at the Japanese yen, we see again the market making strong attempts and momentum to go further down. Now this last week before the beginning of the month, we saw the market reverse through that last thrust down on that bear candle after very strong momentum. The market has come back above that candle. Now we see an inside bar that did not get triggered on the Friday, either side. Then we see an inside bar on the Monday. So we have momentum going north. We want to be able to establish a range at least of where the market knows there are stops or liquidity. And again, regardless of what we think is going to happen, we still can define our maximum stop loss on this trade. So again, as I've said before, look at the beginning of the month. Look for these simple trigger bars. Doesn't mean that every inside bar you come across is going to be a valid trigger. We're going to be looking for momentum. So yes, we have momentum here, but that momentum has now failed, as evidenced by the market clearing that level on the last bear candle. So we have an inside bar. We can define our maximum stop loss regardless of what we think. And we saw a previous inside bar the week before. So the market has broken out 3 inside bars, but we have very strong momentum. If you've read Edwards and McGee, a lot of strong moves will come off of a low or a high with 4 higher closes or 4 lower closes. So again, the market exploded out, cleared that range entirely, and then proceed to follow through and retest the range high from the previous month. So remember what we talked about, whether this is a weekly, monthly, daily candle. Once the market returns through a range, it's going to retest previous highs. So if you look at the monthly candles, once it cleared 50% of that range and it kept auctioning higher, chances are it's going to clear the other high. So we look for some simple triggers like that, traders. Double inside bar on the Monday, again a bear bar. We saw a breakout pullback, and then we saw the market again auction further north and retest old highs. So keep it simple, traders. Look for trigger bars, look for momentum in the market, keep it simple, and most importantly, manage the downside and define your risk. Hopefully you got some value out of today's video, traders. Keep it simple and have a great trading week. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.